All right, welcome you guys. This is going to be a very special class on dealing ranges. We're going to talk about what's a dealing range, how to use it to your advantage, how to find them, and multiple dealing ranges in the same area. So let's just jump right into it. So before we actually get to the candlesticks, like what the candles look like and all that, we're going to first do it in a line chart so it's very easy to spot once we go to the candles. First, let's talk about what is a dealing range? A dealing range is simply when price does something like this. We'll be moving up, may start moving down. We'll put in swing points. Dealing ranges are basically formed off of swing points. So every single dealing range that you see is from a swing point. What does that mean exactly? It means that you really need to be good at finding swing points. Okay, to find a dealing range, you first need to find two swing points. What does that mean exactly? We're simply looking at the highs and lows of a major range. And of course, you don't know what a range means, but we're simply just looking at the major highs and lows here. Okay, that's all it is. That's all you're doing when you find a dealing range. To simplify it even more, you could say a swing point can be defined as the highest high or the lowest low. What does that mean? We're simply just marking out this highest high right here and this lowest low right there. And for this, you could use a Gann box. That's my favorite. We'd simply mark out the highest high and the lowest low with our Gann box. Or you could use a fib. You can simply place a fib on the highest point here and the lowest point there. And this would be your dealing range right here. Simple. Now, if you want the settings for this Gann box, like I said, I personally use the Gann box for this because it's just easier to see. If you want the Gann box settings, here you go. Make sure you screenshot. Okay. But yeah, guys, when we're looking at these swing points, all you're simply doing is looking at the highest one and the lowest one. Now, what does this exactly mean? It means that price has put in a dealing range. Price has put in a dealing range here. That's what this is. When we put our Gann box at the top and the bottom of the major swing points, the highest high and the lowest low, we have created a dealing range. What this means is that we should be expecting price to come back to 50%. Why 50%, you may ask? It's because when we come back to 50% of a dealing range, price is looking to give everyone a fair opportunity to get in. Okay, because sometimes we drop down super aggressive and no one's able to get in a proper entry without chasing, right? When we come back to 50, when we come back to the middle, because that's what 50 is, we are basically giving everyone a free chance or a fair chance to get in the market. When we come back to this 50, this is everyone's fair shot at getting in this bearish move. And then we'll drop down to the bottom. So before we start talking about what's supposed to happen at 50 and all that kind of stuff, let's go over a bullish example as well. So price may be moving down like this. Put in the high, and then we'll do this. And once again, where's our swing points here? We'd be simply looking for the lowest low and then the highest high that we can clearly see. And then you simply put a Gann box on it like this. And for the Gann box, it really doesn't matter which way you start. You know, you can start from the bottom to the top, or you can start from the top to the bottom, because it doesn't really matter. The reason why it doesn't matter is because the 50 is in the same spot. Okay, the only thing that changes here is the 25 and 75. But just know it doesn't really matter which way you draw it when you use a Gann box. Okay, when you draw a fib, it does matter. But in a bullish dealing range, we'll be moving up. Price puts in a swing low and a swing high, and we expect it to come back to 50. Once again, why 50%? It's because it's price's way of giving everyone a fair opportunity to get in the trade and to catch a good trade, really. So the next part we're going to talk about is how would you know what is a bullish or bearish dealing range? Because you heard me say, okay, this is a bullish dealing range and this is a bearish one, but how do we know? You'll know if price is putting in a bullish or bearish dealing range based on the predominant way that we've been going. Okay, in this example, you can see we mostly went down. That's the predominant way we've been going. It's just down. That's a downward trend, which means it's a bearish dealing range. Another thing about dealing ranges, they also help you keep in line with the trend, because if we have a bearish dealing range, that means we still want to go lower. We'll just come back to 50 and then head lower. Okay, so we'll just have our dealing range. Once again, this is the highest high, the lowest low. We'll come back to 50 here, and then we'll drop back down because we are still bearish. The predominant way that we're going is down. All we're doing is coming back to 50, then we're going to continue to move down. It keeps you aligned with the trend. This is the bullish dealing range because we predominantly went up. right? We put in a swing low here, a swing high there. We mostly went up, but all we would do is simply come down to 50%. We come down to this red line, 50%, and then blast right back up because we still want to go higher. It's still a bullish trend. And that's why dealing ranges are so useful, because you can catch the real move, because it's almost like a little fake out to give everyone a fair chance once again, and then we'll go in that same direction we started in. Once we tap 50, you should expect us to go back in the original way we've been going. Okay, if it's a bearish dealing range, if we've been going down for the most part, we'll hit 50 and keep going down. If we've been going up, as in we have a bullish dealing range, we'll hit 50 and continue going back up. Simple as that. So now we're going to look at some real candlestick examples. Okay, so for this, I'm on the 5-minute time frame, just for an example. What we can see here is that price put in a swing high, and it's moving lower. Okay, how do we know this is a swing high? Go to your line chart. Once again, it's your cheat code for everything. You'd simply go in the line chart and look for a highest high that you see. Okay, we have one right here. Once again, we're looking for the highest points that we can possibly see. We have another one here. We have another one there. And then you put it back in candlestick form. For this, you really do want to grab the highest wick that you can see. So for example, we have this wick right there. This one doesn't really have too big of a wick. We have another wick right there. Okay. Once again, we want the highest point and the lowest point. Right now, we don't know if price wants to keep going lower until we do something like this. It looks like we're moving up a little bit. Once we get this move up, what does that create? It creates a swing point. So once again, we have that swing low now. This is the lowest point that we can see right now. If price is going up, we can expect price to then come back to 50% of this down move, okay? So we're just going to keep it simple for now. But I'll talk about when you want to use this one instead of this one. But for now, we're just going to keep it very simple. We can see there's a swing high here, a swing low there. Once again, putting it back in candlestick form. This means that we have a dealing range. Okay, so we put our GAN box starting from the top to the bottom, like this, right on the wicks. And you can see we did hit 50%. This 50 is being hit. We should expect price to go where? Back to the bottom. Why should we expect price to go back to the bottom? It's because this is a bearish dealing range. How do we know it's a bearish dealing range? It's because price predominantly went down before giving us a swing low, and then we move back up. As soon as we move back up, you should expect 50 to hit, at least 50% to be hit in a bearish dealing range once again. And once we hit 50, just as a general rule of thumb, we'll hit 50 and come back to where we started, or where we put in that swing low. Remember, we'll hit 50 and go back in the original direction of whatever dealing range you're looking at. So once again, bearish dealing range here, we should hit 50 here and then do what? Eventually make our way back down to the dealing range low. To simplify it even more, in a bearish dealing range, we should hit 50 and go back down to the swing low that we have. And when we have a bullish dealing range, we should hit 50% and go up. Okay, we'll go over a bullish example in a second. But you can clearly see here we hit 50 and we went down. Now, let's talk about how can we use this to our advantage? Okay, how can we actually use this? Well, for one, if you're expecting price to hit 50% and go down, you can look for a short somewhere up here, either right at 50 or some sort of fair value gap or a PD array that lines up right at 50%. You can short that. Or to give you better odds, you can short just slightly above 50. Okay, now this is where we have to talk about premium and discount. So premium and discount is simply this. When we have a dealing range, say for example, this right here is our dealing range, just for example, we wanted to come back to 50%, right? We wanted to come back to the 0.5. However, everything above this 0.5 is considered premium, which is a good short, and everything beneath this 50 is called discount. Okay, we're going to talk about that in depth in a second, but for now we need to focus on how to use this to our advantage practically. So if everything above this is premium, that means we want to short up here. Okay, why do we want to short up here? It's no different than when you're shopping at a store. You want a discount on whatever you're trying to buy. You don't want to buy it when it's not on sale, right? Premium is where you want to short. Discount is where you want to long. You want to long when there's a sale. Okay, you want to short when there's a sale. This is the short version of a sale in premiums. Okay, so this red box represents premium. I'll explain it better in a second because that's probably not going to be too useful for people who are brand new. Just remember, everything beneath this red line is discount. If there's two things you remember from this class, it's these two things right here. In a bearish dealing range, we hit 50 and go down. A bullish dealing range, we hit 50 and go up. And then you want to long in discount. Short and premium. I guess it'd technically be 4 things you need to remember. But these are the 4 core things you need to remember from this class, okay? You only want to short and premium. You only want to long and discount. If we have a bearish dealing range here, we want to short once it hits premium. Simple as that, which means our short should be somewhere in this upper half of this bearish FEG. Okay, I don't want to have too much on the screen here. Remember, this bearish gap that we have on the 5-minute is within 50% of this range. We'll get rid of the premium for a second as well. Just remember, everything above this red line is premium. You want to short when it's above this. What do we have above it? We have a bearish FEG, the upper half of this FEG on the 5-minute. We also have an OB here on the 5-minute. Now, once again, I'm not here to talk about OBs or anything like that, but this would be a good short because it's in premium. To get it where? To the bottom of the dealing range. Now, that's just one example. Let's go over another one. So, for example, we have what could be a bullish dealing range here. Now, you can look at this both ways. We're only focusing on the bullish one. So, for example, once again, you put it in your line chart as the cheat code. We're looking at the bullish dealing range, so we would be looking at the swing low here, all the way up to the swing high here, like this. We put it back in candlestick form, and we're just going to move it to the wicks because we're looking for the highest wick and the lowest wick. How do we know this is a bullish dealing range? From what we currently have. Once again, imagine that we're starting from this 1032 candle and onward. Ignore this behind it, okay? We're predominantly moving up. From this low to this high, we predominantly moved up, okay, which means it's a bullish dealing range. If we have a bullish dealing range, what do we want to do? We want to long in discount, and we want to short in premium. If you have a bullish dealing range, though, we only want to long because that's the trend. Remember, your dealing ranges also tell you what trend we're in. If it's a bullish dealing range, we're in a bullish trend. We only want it to come to 50 or slightly beneath 50 because why? It's in discount. Remember, you want to long when it's on sale in discount. Okay, what do we have in discount? We have a bullish FEG down here. We have another bullish FEG right here, right at 50. I'm going to move this discount a little bit over. And we have 2 FEGs here. You can take your pick, but as long as you know you want to get in beneath this red line, okay, that should be your goal. Get in discount. Get in at 50. And once you get in here, where do you target? The dealing range high. Because why? If we hit 50, we're going back to the upside if it's a bullish dealing range. Okay, remember, long in discount, short in premium, but also when we have a bullish dealing range, we should hit 50 and go up. Simple as that. We hit 50 here, where should we go? Right back up. Where's up? In this sense, it's to the top of the dealing range. And we do just that. And that's exactly how you use it to your advantage. You simply long once we hit 50 in a bullish dealing range and get back to that dealing range high. Simple as that. This really is as simple as that. And now once we take this high, we create another dealing range. That's what ends up happening here. We put in a swing high up there. We have a new 50%. Once again, putting in line chart. You can see it's still that same swing low. We put in a new swing high. Why? Because we took another high there. And now we have a new 50%. We're simply waiting for price to come back to 50. Does it happen? It does. Which means you want to long anywhere down here because why? It's discount. So we want to long anywhere down here to get where? Back to the daily range high. We hit 50, we should go up. Takes a little minute, but that's what ends up happening. Now, this is also a good example of knowing when dealing ranges to form. That's also what we're going to talk about next. So when should we expect a dealing range to form? That's when you expect a dealing range play after its previous swing high or swing low has been taken. What do we have here? It's just an example we just showed. Okay, we had a internal dealing range here, a previous one, right? How did this even form in the first place? Because we took out a swing low right here. We took out a swing low there. Someone would be looking at us to retrace to this bearish dealing range, right? Because technically speaking, this is a downward move. You could have expected us to hit 50 here and drop down again. You absolutely could have. However, what's the one thing that we still did there? We still went to 50. Once you get good at this dealing range stuff, you can take the long back to 50 and then try to short off of it. You can catch both the moves. However, we're going to only focus on the second move actually, which is just off of 50%. But once again, once you get good at this, you can have a dealing range here marked out and say, yep, we're just going to come back to 50. You can long back to this. Absolutely, you can. But since we're only looking at the bullish dealing range in this example, once again, hindsight is, 2020. We hit 50 here after sweeping out low. We have a bullish dealing range. We hit 50 here. We come back to the high. And what we do, we take out another high. Once again, where do we expect a new dealing range to form after we take out a previous swing high or swing low? This was a previous swing high. We just took it out, which means we could potentially have a new dealing range. How do we know it's a dealing range? We could just keep going higher here. We have to wait until a swing high is put in, which means we have to basically turn back around. We have to start moving lower. Okay, it looks like we might start moving lower here. Well, what would happen if we just swept this high again and kept going up? Well, then you simply have to move your dealing range higher just a little bit. You simply just wait until we start putting in a swing low, until we start moving in this direction. Remember, once you get really good at it, you can short down to this. But we're simply only talking about if you're kind of new, you would just wait for us to hit 50 here for a new long because you're expecting us to go back up. So someone in the chat asked a very good question. They asked, Plow, why wouldn't you draw 50% from that first low? I think he's talking about this low right here. That's a good question. It's because, well, actually, I would have drawn it from this first low at, for example, like this. In live time, I would have had it like this. Okay, I would have had it like this. But as we swept that low, it just gets moved a little bit lower. And then you're still looking for us to come back to 50. You're simply looking at the lowest low. You don't keep it right here after we've already swept that low. You have to adjust. Simple as that. Because the low was swept here, we simply move it just a little bit lower. What if I felt like this was the bullish dealing range, right? All we do is keep going higher. So you have to adjust it. Simple as that. I just readjust it to this, right? Until we hit that 50. And then once we hit 50, you can see reaction. You can take a long back up to the dealing range high. Now, we're going to talk about now dealing range within another dealing range because it happens a lot. Okay, so now this last part we're going to talk about is external and internal dealing ranges. What does this mean? External dealing range is your higher time frame dealing range. Your higher time frame dealing range. For example, I've moved all the way up to the daily now. You may be wondering, well, Playa, why on earth are you on the daily here? It's because if you use this concept, it works on every single time frame. It does not stop. It repeats repeatedly on every single time frame. Okay, so let's see if we can find a dealing range here on the daily. And some of you probably may have not noticed this, but this was a dealing range play on the daily. Okay, we're simply going to put the lowest low that we can currently see that started this entire move up from this low to the high that we had. Look what happens here. We dip down and hit 50, and you put it back in candlestick form. We're going to simply put it on this wick here and at this wick right here, ignoring what happens afterwards because it's kind of hindsight. But you can see, even on that vicious dump that we had, this was a very crazy dump in one day. We dumped like 1,000 points this day. We stopped kind of at 50%. If we stop here at 50 and hold it, you can expect us to try to make a move back to the dealing range high. Okay, now this is the daily. It's not that useful because we're not swing traders, right? But say if we went to something like the 1 hour. Remember, we start on the daily. We have 50% here marked. Now we're going to go down to the 1 hour. Okay, the 1 hour has put in a low here and it put in a high there. What does that mean? It's a swing low here and a swing high there. That is our internal range. So once again, backing out to the daily, we have a massive dealing range that's external. Then we go down to the 1 hour and we have another dealing range. Once again, putting in line chart, you can see the swing low here, the swing high there. This would be an internal dealing range like this, and we put it back in candlestick form. We put that wick low to that wick high. Look what happens here. We hit 50. We should expect a move back up out of it, back to what? The dealing range high. The key to this external and internal dealing ranges, you want them to be in the same direction. Okay, for example, back on the daily, this is a bullish dealing range. How do we know it's a bullish dealing range? Because we predominantly went up. It's a bullish trend. All we did was get a nasty stop run back to 50. If we hit 50 here, we should go back up, which means it's still a bullish dealing range. On the 1 hour, it's a bullish dealing range. We went predominantly up. We come back to 50. We can expect price to go back up. Now, let's take it a step further. On this way back up, what do we have here? It looks like another internal dealing range. It's a swing. It's a swing low here. It's a swing high there. How can we see that a bit better? So let me first mark out what we have so it's not super confusing. This right here is our daily 50%. This right here is our 1 hour 50%. So we got the daily, we got the 1 hour. Now let's drop down to the 15-minute. What do we have on the 15-minute? Another dealing range. Okay, let me get rid of some of these lines. Once again, so it's easier to see. We have a swing low here. We have a swing high there. Looks like we just barely missed it. This is actually the day I think we just barely missed it, actually. Let's see, does it eventually come back? just going to fast forward all the way. Looks like it did come back. That's okay. It didn't really have to because we already hit the 1 hour, right? If we hit the 1 hour 50% here, where should we go? We're supposed to get back to this high. Does that end up happening? Let's see. It sure does. Okay. Remember what I said about dealing ranges. A new dealing range has formed once what? After we sweep a previous swing high. What just happened here? We swept the previous swing high. We dipped back down. Guess what we just hit on that dip back down? At 50%. That's exactly why we get this massive wick, because it doesn't want to stay beneath 50. So if you go back to the 15-minute from there, after taking out this previous swing high, we still have a massive dealing range on the 15-minute, ignoring this one now in the 1 hour because it's already completed. We have this swing low here. We put it to this swing high up there. We'll call this previous swing high. You can see we hit 50 here. Where should we go if 50 holds? Back to the dealing range high, and let's see what happens here. Does that end up happening? Yes. And once again, we swept out a previous swing high there. We're going to come back to this dealing range 50. Now, this one doesn't end up holding, but however, it's still a draw because if we made a new 50 here, you can expect us to come back down to this 50%. Once again, you can play both sides of this. You can play the short back to 50 and the reaction off of it if there's a reaction. Now, in this case, there wasn't a reaction. We kept going down, but there's still multiple dealing range plays within this as well. It works on every single time frame. Because remember, we just did external to internal dealing ranges starting from the daily, using the daily as our guide for 50%. And actually, let's just play it out so we can see what actually happened here. But we hit 50 there on the daily and we went back to the dealing range high. Simple as that. This was all just one major dealing range play. Absolutely. And what happens after we hit 50? That was a previous swing high. We created a new dealing range here. Wherever we stop at and turn back around, we have a new 50% waiting to be tapped into. I know it looks like we'd already tapped into it, but we haven't yet, technically. Just know, if we ever turn back around after sweeping this previous swing high, we absolutely would come down to this 50%. Absolutely. Let's go and talk about my favorite time frames to use for dealing ranges. Remember how I went to the daily just now and said that's external? For me personally, my external one that I love to use is the 5-minute. So I'll start on the 5-minute as my external dealing range. For example, say we put in a low down here and a high right here. You may be wondering, well, Plyo, how is this a dealing range? It's because on the lower time frame, you can't really see on the 5-minute, but this is from experience. If we went back to replay right about here, this is technically a swing high and low on the 1-minute. This is a swing low. This is a swing high. We start dipping down. Where are we going to hit? 50. Fast forwarded on the 1-minute here, you can see we dipped down to 50. Where did we go after that? Back to the dealing range high. It really is that simple, guys. It really is. But yeah, guys, I hope you learned a lot about dealing ranges. We're going to wrap it up there. Yeah, we'll see you in the next one. Peace.